So guys, as much as I do not want to alarm you, I know that you want the truth. These massive margin calls may just wipe out a lot of people in the stock market. I mean, just look here. People owing as much as $179,000. The headline, options traders hit with massive margin calls as winning bets against failing banks are left in limbo for weeks. Not to mention the fact that all banks are already insolvent with unrealized losses on the books, and that is getting ready to blow. Now, this happened when markets froze trading for Signature and for Silicon Valley Bank for a whole 2 weeks. Since Silicon Valley Bank and Signature Bank had been placed into FDIC receivership, traders felt that their options should be worth their maximum values as shares in both companies would likely become worthless. This is according to traders. Now, the only problem was that the trading of both stocks had been halted, making it completely virtually impossible for brokers to accurately value option positions. Brokers initially were going to let these people's stock options expire worthless. Communications with broker help desks initially showed platforms were unable or unwilling to help customers exit their positions, meaning those with winning bets might see them expire worthless, while those on the other side of the trade would be spared massive losses. Completely unfair if you ask me. Now, one news report estimated the value of put options on Signature and SVB expiring back then at nearly $300 million. Now, this could blow up even more as another massive margin call could be happening pretty soon. Now, wait a second here. I may be getting ahead of myself. Let's first talk about what a margin call is in the first place, right? When you borrow money to fund part of your investments, you're required to put up collateral, usually cash. Now, if your investment falls below a certain level as a percentage of the value of an investment held in the brokerage, then the broker issues a margin call. And so a margin call is when you're required to deposit more funds to keep the amount of your investments above the margin. And so this is a margin call. People also do this with debt like loans and bonds, making things riskier because you're basically buying debt with more debt. In fact, debt markets are more highly leveraged than equity markets. Then, of course, there's the euro-dollar system where dollars exist outside of the direct oversight of the U.S. Federal Reserve. And so this happens when the U.S. dollars are used for international transactions. They end up in foreign banks. These banks can then use these dollars to create loans, which results in the creation of even more dollars in circulation outside of the U.S. The problem? Well, they're building up this kind of major shadow dollar debt globally, so you have financial institutions, especially in Europe, that may be holding a significant amount of assets that are losing value, potentially leading to forced asset liquidation and distress in the market down the line. You remember what happened to Signature Bank and Silicon Valley Bank, right? Now, imagine that happening on a much bigger scale. One guy from Miami Beach, he was carrying a margin call balance of nearly $179,000 for more than a week after his puts against Signature Bank were converted into a short position in the company's shares marked at the then price of $70. Now, while he waited for Signature shares to trade again, his daughter was born a few weeks premature to a surrogate in Colombia. Fortunately enough, he managed to close out his position for a six-figure profit once shares of Signature saw their value decline by more than 99% when they reopened. Now, what happens if this kind of thing spreads out to even more banks, more financial institutions, and their stocks? Well, the stock brokerages won't necessarily force you to sell your position. They ask for more money to be deposited into your account to cover any kind of losses. But if you can't do that, if you can't afford to put more money into the account, then you have to sell enough assets held in your account. And then that's where we're going to see the massive wipeout, guys. Just look at what's happening with the real estate market in China right now, right? To keep prices high and to avoid price drops due to the market being poor, they handed out gold to artificially inflate the market. The people that will be buying from these developers will be using said gold bars to be able to pay for their house. So they can keep the same pay. They circumvented the government's decision by going over their heads and putting money back into the market to avoid price drops. Think of it this way. Developers can't sell a $450,000 house. Developer wants to drop the price to $400,000, but the government says no, as it will crash the market. So then the customer goes and buys the property for $450,000. The sale is recorded as $450,000, and the buyer gets a rebate in the form of a gold bar that is worth $50,000. Yeah, I know it's ridiculous, but it's kind of like this huge artificial bubble that you feel it's going to pop any day now. I'm telling you. Moral of the story, do not mess with leverage unless you really know what you're doing. Financial leverage can be a great benefit for investors. Without leverage, people wouldn't be able to make purchases that far exceed their incomes. millions of Americans would be unable to buy homes or automobiles. When leverage is applied to financial instruments that increase in price, returns can be enormous. But when leveraged investments go south, then the result could be a margin call or a demand from a lender to deposit more capital into an account quickly. Now, the upside of buying stocks on margin is that they leverage your investment, and that lets you buy far more than what you could afford otherwise, and hopefully increases your gains down the line. Now, of course, the flip side of the coin is that buying stocks on margin is that they leverage your investment, allowing you to potentially purchase far more than you could otherwise afford, and it also would increase your losses if the trade goes south. Bottom line, buying securities on margin can allow you to win big or lose big. Now, if you look at history, large numbers of margin calls have been known to lead to some pretty significant financial crises in the past century. During the 1920s, the stock market boomed, and an increasing number of speculators bought stock with as little as 10% collateral. But when the market crashed in October 1929, millions of ordinary Americans who had invested their savings in the stocks, they were financially wiped out. Unemployment approached 25%, and real wages fell more than 40%. The U.S. economy recovered only after entering a global war that killed at least 70 million people, or about 3% of the world's population. The Great Depression made the Fed establish a minimum margin in 1934 to roughly 40% so they could discourage excessive speculation and the creation of stock market bubbles. Central bankers set the minimum at 50% in 1974, and it's remained unchanged ever since then. But we saw the same thing again in 2007, when the value of mortgage-backed securities plummeted during a massive housing bust. Banks that had loaned assets to investment bank Bear Stearns ordered it to increase collateral for the lost value. Bear Stearns was forced to sell $3.8 billion in collateralized debt obligations in order to cover the margin call, and would end up declaring bankruptcy in the first of a lot of financial dominoes to fall in what we now know as the Great Recession. Now, if we look back between 2007 and mid-2009, when the downturn officially ended, U.S. households lost more than $16 trillion in wealth, with $6 trillion in real estate losses alone. The S&P 500 fell 37.6% during the Great Recession. Now, that's a whole lot more than the 10% loss during the 3-month recession in the early stages of the C-19 pandemic, and you guys remember how crazy the pandemic was. So when that margin comes a-calling, it may just be the worst thing that can happen to an investor. Investing with borrowed money can be a huge boost to your income stream, but it can also go wrong real fast. Basically, people who buy stocks on margin should be aware of the potential downsides and manage their risks accordingly. Now, speaking of risks, there's talk about the big Jackson Hole speech from Jerome Powell and the Federal Reserve coming up. Check it out.
And I think right now, if we think about where the Fed is, where the internal debates are going, they're trying to sort out just how far they have to go in terms of hiking rates. They're also now, you can hear the debate shifting from the peak to how long they're going to hold rates at the peak. All of which to me says that Powell's, if he thinks about risk reward, what is he trying to achieve here? He's got to keep markets believing that they're going to drive inflation down over time. He's got to keep markets believing that if things turn out worse than they expect, higher inflation, stronger growth, they'll hike some more. But boy, it's not really clear, especially given over the past year and a half, how many times they've said some things and had to reverse course, that he wants to be overly explicit about the precise policy choices they're going to make. So I think it's about tone. I think it's about striking that hawkish tone that we're going to keep at this job until it's done. But I don't know that he's going to want to lay down the next level of detail, i.e., here's what we're going to do at the next 1 or 2 meetings.
Yeah. Already, experts are saying that the 2023 stock market rally is over, as the Fed isn't easing anytime soon, and a hard landing of the economy is inevitable. The benchmark index S&P 500 rallied nearly 20% through July, and the benchmark index is still just 9% shy of an all-time high, even after August's tough sell-off. But they're already warning investors to not be so sure that the gains will keep coming, especially with all the headwinds that are blowing around. Stock prices are high relative to earnings. The S&P 500 is currently trading around a price-to-earning ratio of 20, something that experts see as a ceiling right now. investor positioning is too bullish. Definitely a turnaround from the start of the year when investors were overly bearish. Investors pumped $45 billion into stocks during the month of June alone. But monetary policy is likely to remain tight. Federal Reserve officials will likely keep interest rates elevated through the rest of the year, and they're not likely to start cutting rates anytime soon as they continue to keep an eye on inflation. And fiscal policy will probably get even tighter. 2023 has been a massive fiscal earnings year, as the government shelled out $1.8 trillion, but federal spending will likely still pull back significantly in 2024, so that could certainly weigh on the economic growth. Okay, yeah. Commentators on the bull side are still insisting that the US could still avoid a recession and that the economy is still so resilient. But they have to know the reason the economy is so resilient is because of a strong fiscal spending and consumer spending, both of which are expected to decline into 2024. Consumer savings are also dwindling fast, so that'll remove yet another buffer that's been the cushion of the economy from the financial cliff that we're about to drive off of. Basically, there is no landing. No landing until you get that hard landing. It's just hard to believe that inflation is going to come down. The Fed is going to be cutting interest rates and growth will be fine. What do you guys think? Now, more closely, stocks could tumble 15% even in the event of a mild downturn. Plus, you got the next Fed rate hike meeting. Investors are now pricing in a 42% chance that the Fed will raise rates another 25 basis points in their next meeting. Meanwhile, the New York Fed sees a recession as more likely than not over the next year, forecasting a 66% chance that the economy will tip into a downturn by July of 2024. The government plans to borrow a lot of money, over $5 billion every single day for the next 10 years. And so this means that the total debt will likely go above $50 trillion. Now, what does this have to do with margin calls, right? Well, this is happening in the market for government debt. Countries like China and Japan, who own a lot of our US debt, they want to sell, which could make its price drop even more. And at this point, despite recent drops in the stock market, stock prices are still relatively high. Even though there are many economic problems happening around the world, this means stocks are probably worth less than they seem. Now, if that's not a recipe for disaster, I don't know what is.